Hey everyone, this is Daniel Rondberg. I want to welcome you to this video. In this video, I'm going to break down what's called the GUL. GUL stands for Guaranteed Universal Life. This is a product that is missing in terms of people that are looking to help their retirement to remove certain key risks. And I think it serves a lot of value to people, and it's worth having conversation over so you can understand how you can position it in your own retirement to make sure that you are as secure as possible in removing obvious, blatant key risks that could really mess up your retirement income or your wealth transfer strategy. Now, universal life is generally known as flexible life insurance. That's one of the benefits of universal life. And universal life is very complex in my mind. A lot of people say it's simple. I don't think so, because you have universal life, which is essentially just the company giving you an interest rate that they declare every year. And the interest rate and the cost in your policy and the timing of your premiums, the mode of your premiums, all plays a role in how long your policy will be there for you. Now, index universal life is going to be tied to the performance of an index up to a cap, and you're hoping that, again, the timing of your premiums, the mode of your premiums, potential interest or index credits that the policy earns from the performance of the index, and the fees all factor into how long your policy will last. And so there enters a third category, and there's a couple more, but what I'm going to focus on is the GUL. One of my biggest critiques of universal life that I've seen is in a declining interest rate environment, which I've operated in as an agent for the last 9 years. People purchased universal life in the 90s. Interest rates went down and down and down and down. The interest rate that the policy paid went down and down and down. I come along, I run an in-force illustration for somebody I meet, meaning that I go to their company and I say, okay, show me how long this policy is going to last based on what it's earned so far. And it lapses a lot earlier than people thought. Not a great conversation. What happens is people purchase something that they counted on to be there because they didn't review it with their agent often, because they just thought it was going to keep going, because they thought it was going to do what the original illustration said it was going to do. Now it's going to lapse. And that is a terrible conversation to have with somebody, because they need to put in, potentially in some cases, a lot more money to keep that thing going. Very disappointing. Not a great situation. I've been in that situation many times, not on policies that I've written, but policies I've come along and reviewed and found that, we're going to have a lapse unless we make adjustments to this policy. Now, index universal life gets into a whole nother category, and I'm really not going to go too deep into it in this video because it's not really what this video is about. I have some things that I think index universal life provides some value on, and I think I have some pretty harsh critiques on index universal life. I think it depends on what you're looking to use it for. A place where index universal life has served a lot of value is people will tend to go to index universal life to try to get more death benefit, or to be able to get a death benefit by putting in less premium, because they're hoping that the index performance, the upside potential of the policy's index credit earning potential from the underlying index, will give credits to the cash value, and that will help lengthen the policy because it's adding more potential value in really good years. And I've seen some cases where that's worked out really phenomenally well for people. I've also seen cases where the policy didn't perform and it did not work out so well for people. So again, I think index universal life is a tough one. The reason why I've typically stayed away from index universal life when somebody is trying to just accomplish a death benefit that they can count on is that performance risk, I think, is sometimes too high. Because when you're purchasing a benefit that you need to be there for you, it's got to be rock solid. It's got to be there when you need it. And I think index universal life can do that, but I think it also has that ability where it could perform less than expected. And if you're not realistic about your performance assumptions up front, you could end up getting disappointed because you may have to lower that death benefit in order to keep the policy in force. And sometimes that does happen when you're using index universal life purely to purchase it for the death benefit protection or living benefit protection. You know, I tell my clients all the time, if you're planning to leave a certain amount of money to somebody to replace your income to protect them, or as a wealth transfer to somebody, or if you're planning on buying a benefit to protect yourself or your spouse for care, it's got to be there for you. Hence, the Guaranteed Universal Life policy. That's really important because Guaranteed Universal Life basically says you purchase this premium, you pay it on time, and the company is going to give you that death benefit guaranteed to certain ages. So you just get to pick. You don't have to worry about performance or the interest rate that a company assigns, or if you're talking about whole life, the dividend that a company assigns. You can just say, okay, I want to purchase this benefit. I want it to be available to this age. Maybe it's age 95, 105, 120, 121. You get to pick what age you want the company to guarantee it to for you. Then you just make those subsequent premiums on time and it'll be there. That's the agreement that the company makes for Guaranteed Universal Life. Now, here's why that's really important. Because if you're trying to plan your retirement income out And let's say, for example, you're having to make choices on Social Security, pension choices, annuity choices. Having a guaranteed universal life policy can really add a lot of value. For instance, a guaranteed universal life policy that can protect your spouse might be the difference between you choosing higher income annuity options, single life annuity income options, higher pension options, straight life pension options, taking your Social Security earlier or later. It has a lot of value because it can replace that income in a windfall that's tax-free to your beneficiary. And you get to decide when exactly you want to have that benefit paid out and how much premium you're willing to pay for it. So you can really make sure that it's going to be in line with your overall cash flow needs, meaning that you'll have enough income for you, but be able to put enough aside for that benefit to replace those lost benefits for your spouse or your children or anybody that you care about that you want to make sure has those benefits if you're not there. And you can make sure that it's going to be there for you. The company's going to give you that promise that, hey, you make the payments and you'll have that benefit available to you. Now, oftentimes a lot of people say, well, Daniel, what about term? Because I can get that benefit for so much cheaper. Here's the statistics on term. LIMRA tells us that on average, term policies pay out less than 1% of the time. Now, why is that? Because they're promised for a term, a period of time. People buy term insurance generally when they have a lot of expenses, maybe they're supporting a family, they have a spouse that would be in trouble, they have a loved one that would be in trouble if their income was no longer there. They can insure that income, they can give that peace of mind, they can give that financial security to make sure that they are basically just buying that risk away. They're transferring that risk to an insurance company, and that insurance company is going to pay to make sure that their income is insured. Now, it's only meant for a period of time. That's what term means. You can buy it in 10-year, 20 or 30-year increments. But as you move into retirement, term becomes less and less viable, because if the statistics are true that it was only enforced 1% of the time and pays that claim 1% of the time when the insured dies, then it's not going to be a viable solution, because remember what I said earlier, you need it to be there for you. That's where guaranteed universal life really plays a role. Now, guaranteed universal life is more expensive in terms of premium, okay? But if that risk is even more expensive than that, it's a really easy way to determine your decision. Meaning that if your family could not survive that risk, then it's an argument that it's maybe more efficient to just remove that risk by dedicating a certain amount of money to premiums. And so guaranteed universal life is the type of strategy that you can make sure is there for you when you need it. Now, guaranteed universal life is really special because you can add a couple of riders to it to really improve some things for you. Number one, you can add a return of premium rider to it. A lot of people say, well, what if I buy this life insurance and then my spouse passes away? And would I drop the life insurance? Well, that's where having a return of premium rider might be really helpful, because let's say, for example, your goals change or life changes, something in your scenario changes drastically and you no longer need that coverage. Well, that return of premium rider would be able to make sure that it refunds all that money back to you, and all the premiums you paid in will come back, so that way there wasn't really a lot of financial risk long-term to you to support that policy for a need that is no longer there. The other rider you can put on that I think is crucial, and I've written a whole book about just these riders on these types of policies, is a accelerated death benefit rider, or also known as a living benefit rider. This rider makes sure that the death benefit can be paid out to you tax-free while you're alive if you meet certain criteria for care. Usually these criteria are some type of critical illness. Examples of that might be a heart attack, it might be a stroke, it might be an organ transplant. Something like that will pay out a portion of the policy to you. A chronic illness rider, this is where typically you can't perform 2 out of 6 activities of daily living. You might need home health care, you might need to go to a nursing home. Then it would pay out larger portions of that death benefit to you, either monthly or in lump sums, to make sure that you have that money to take care of you while you're alive. The third would be a terminal illness benefit, where if you find out you have a life expectancy of 24 or 12 months or less, larger portions of that death benefit will be paid out to you tax-free, so you can utilize that for your care. Or what I think is really important and I think is really just special is to make memories with your loved ones while you can with the time you have left. And that life insurance acceleration of the death benefit to you might be the difference in you taking that trip around the world with your spouse and your family, or not having the means to be able to do it when you have a short window of life left. Talk about something that's really meaningful and powerful. That is one of the benefits of those riders, in addition to being able to pay for medical costs that you could incur during that time. Having that rider attached to the policy is really crucial, because let's say, for example, you have retirement income set up from Social Security, maybe withdrawals from assets, maybe a pension, annuities, whatever that is. And then let's say you have a long-term care event. What asset class are you going to cash in first to pay for that care? Is that going to damage your income or reduce that asset and reduce that income, therefore, for your surviving spouse? Well, having that accelerated benefit rider can kick in substantial amounts of tax-free money to protect your other assets and your income, so you don't have to drain those down to cover your care costs. That's one of the massive benefits of having the right type of life insurance in that scenario. Guaranteed universal life really deserves a seat at the table. I think it's crucial to doing your best to maximize your retirement income, because if you could take higher choices or you could have more options because you have that life insurance policy as a backstop to protect you and your family, I think that gives you more options. I think that gives you more choices. I think that gives you more solutions that you can create to be able to maximize your retirement income. Having that life insurance that has those riders that will accelerate to you for care will give you what some people call a buffer asset. Now, it's not really an asset, it's a benefit, but it will provide tax-free cash to you so that you don't have to spend through your assets. And that may be extremely crucial. Guaranteed universal life insurance plays one more key role that I want to share with people, and I come across this scenario all the time. It's very common. People purchase annuities with lifetime income riders. And they purchase them with good intentions of using the lifetime income, but guess what happens? The lifetime income rider rolls up, it gets to a point where it can provide a benefit. Years down the road, people look at that benefit and go, I'm not gonna take it, I don't need the income. And then what do they have? They have an annuity with a benefit base that can provide income and really no need for the income. So what do you really do in that scenario? You can access that income and do a partial replacement where you finance some of the money from that annuity into a GUL. And when you do that, what's going to happen is you can take, let's say you have $100,000 in an IRA that's an annuity, and that's the current value or the accumulated value. But let's say you have a benefit base in that annuity of $200,000. Okay, if you were to pass away, let's say, for example, this doesn't have a death benefit associated with the annuity, that income account value, that $200,000, won't pass to your beneficiaries in those scenarios. So people look at that and go, well, that's not great. I just purchased this annuity. Maybe it had a fee. I let it roll up this whole time. Now I got this benefit that's not going to do anything for me. Well, that benefit is in charge of basically telling you how much of that lifetime income payment that the annuity will pay every year. The annuity makes a payment every year. The life insurance needs a payment in the form of a premium every year. Well, if you have $100,000 in an IRA, maybe you can take that income rider payment. Maybe it's $10,000 a year. You can fund a GUL, and maybe that premium will buy a $300,000 tax-free death benefit. So what did you effectively do? You took $100,000 of IRA and you were able to transfer $300,000 of tax-free wealth to your beneficiary just by putting the two pieces together and creating a suitable replacement. That is another great use case for GUL and something that is very common that people are taking advantage of. Or let's say you take out that GUL and you can attach a living benefit rider to it where it'll pay out a portion of that death benefit tax-free for care. Well, what did you do? You took a fully taxable annuity that's in an IRA, you funded by paying the taxes on a portion of that income rider payment into a GUL, and then you created a tax-free benefit that GUL could pay you while you're alive to offer you benefits for care. It's really a phenomenal strategy. So if you have more questions on this, please leave comments, give me a thumbs up, share the video, think about subscribing. I'm going to put out more content like this so I can help to get my message out there and share this with more people. I want to bring clarity to some of these more complex insurance issues so that you can live out your purpose in retirement and find the right tools to give you financial permission to spend confidently knowing you have the right protection in place. I think that's so crucial. So thanks again for watching. I really appreciate it. I'll see you in the next one.